You just mentioned debt, credit. That leads fortuitously into our stock of the day. It is Credit Corp. Now, it is forecasting it's on track to achieve full-year NPAT growth of 6 to 17%. Net profit for the half year came in at just over $44 million, in line with the prior year, reflecting reduced earnings in the half arising from strong loan book growth, disruptions to its debt purchases in Australia and New Zealand. And Chief Executive Thomas Beregi saying both these factors will produce higher earnings over the second half, and is also confident on the outlook for the US business.
It's up over 60% over the prior year, so it's certainly on track. Have we achieved everything over that 10-year period that we set out to do? Certainly not. I think the best performance from our US business is still ahead of us.
Well, investors will receive an interim dividend of 32 cents a share. Shares, though, hitting a 9-month low on a perceived profit miss there for the first half NPAT of 44 million, which will miss Jeffrey's estimates of 50 million. So you can see shares down 13% off the back of that news. Scott, let's start with you. What do you think?
The share price didn't fall because the business went backwards. The share price fell because the market decided that it expected more. So we've got to separate the stock from the company. That being said, no profit growth is not a great story, particularly for a business that has those growth aspirations, and particularly despite the growth in the US business, as was just heard. 23% increase in collections in the US. So the US business was working. What investors are now saying, well, hang on, if that's working, what's not? And that's kind of the key question here. Now, the business of Credit Corp was very clear to say, no, full year we're fine, full year we're fine. We'll talk a couple of times, I imagine, this hour about how companies tell us the story they want to tell us. But you only look at the release. And look, everyone does it. But here's the thing. They said, well, we're on track for full year profit growth. In fact, the announcement was actually about the half year. They then said, well, the US collections are up. No mention of Australian collections. About record lending volume, and then strong growth in the debt ledger in Australia and New Zealand. So they kind of picked the highlights. Again, every company does it. It's not a whack at Credit Corp. There's no consistency through those bullet points for absolutely every reason you expect. If it was good overall, they'd say, great, strong collections in both countries. Or they'd say, debt ledger in both countries. They're being very specific to message the message, to massage the message, I probably should say. And so, look, it was a fine result. Profit in line with last year is fine. Particularly, by the way, in a business where you're not getting meaningful increases in collections, you want to have some sort of cost control, because we've seen plenty of businesses, most obvious in the retail space, but across the board, where modest increases in sales and revenue is not enough to cover the increase in costs. We know costs continue to grow at pretty high rates. So I think an okay result from Credit Corp. Nowhere near what the market wanted, as you've already mentioned. I mean, that's a pretty significant 15% miss against the Jefferies number, and no surprise, shares down about 14%. I don't have a strong view on Credit Corp's long-term performance. It's a really tough business. There's cycles within cycles for this. You've got the cost of the debt ledgers you're buying. You've got the cost of collections. You've got the ability to collect based on the collectees, if you like, the people who owe the debt, their ability to pay back, and that tends to be economically related as well. So you kind of got to put all this together and say, well, where are we at? How much are they having to pay? What's the competition like? How good are we at collecting? How likely can we collect based on the conditions or the circumstances of those from whom we're trying to collect the debt? So really, really stupidly difficult. I owned shares in Collection House years ago before they left the ASX. Thankfully not when they left the ASX. It didn't go well, that one. But, it's just a really, really tough business to be in. The basics are very clear and straightforward. I've got to say, these guys, as an industry, we talk about commodity players being price takers. So are debt collectors. They're basically bidding for the ledger, and the lowest bid wins. So you've got this situation where maybe even not the commodity players, maybe they're more like civil contractors, the land leases of the world. They're kind of saying, well, how much do I have to pay? Okay, well, it's got to be that price. All right, well, I guess that's what I'll do. So you pay as much as you can, or as much as you can afford to. You then hope desperately, you've already bought the asset, you then wait to see whether you can collect on that asset. So it's you take all the risk up front. Now, there's some upside if you collect more than you expect, meaningful downside if you don't. Looks cheap on a PE basis. It's about 10 times earnings. You say, well, hang on, that's not asking for much. The market is not confident that in a tougher economic circumstance, Credit Corp can actually manage to collect on what it's already paid out for. Tempting to want to buy it at this price. If you're a deep value person, you maybe think single digit PE, man, why wouldn't you? I can't say I would buy it at the current price. You can't control your price, control your operations. The numbers year on year flat suggest not everything is well with Collection House. If you're an optimist, you say, well, they're going to bounce back. If you're a pessimist, you say, well, maybe this is a harbinger of things to come. If you don't know, you stay away. So I'm going to give it a miss.
All right. We'll call it a hold. Is that fair enough?
Yeah, let's call it a hold.
Okay. All right. Shawn?
I missed the stock, as you know, because I was on the in the Uber on the way into the office.
Yeah, right.
So I haven't dived into Credit Corp as closely as I might like. To me, it comes down to a couple of very simple factors. And Scott talked at length about the stock, so thank you for that, Scott. It's been struggling for a long time. You had the graph up there before. It's been struggling now for 3 or 4 years. It's effectively missed quite badly today. The stock's down 14%, missed expectations. There we are, great. Was $34, today it's $12. We are not in a market where investors are trying to pick the dip of stocks that miss. We're in a momentum market. I don't want to go back to gold. People are talking about gold all the time at the moment, but people
We'll get to that, yes.
Yeah, I'm sure we will. I've looked at the next stock. This is a stock that's struggling. It's just missed. I don't see any reason why you'd buy it.
All right. Would you
Simple
sell it
as that.
if you were there? Just avoid.
You know what? If I was holding it, I probably would sell it. I'm sure there are better places to be.
Yep. Okay.
Well, there are better places to be, in my opinion.
Righto, that is our stock of the day, Credit Corp. It is a hold and a sell, both fairly negative on that stock.